we're going to continue. Now, we laid out a table for how to keep track of the inventory and for how to cost it, and then how to value the ending inventory. Now we're going to look at how do you journalize those entries and enter them into the general ledger. And the first one I'm going to show you the journal entries. Each journal entry, each set of journal entries, because there's going to be one for FIFO, LIFO, and weighted average. The entry or the accounts themselves are going to be the same. It's just going to be the amounts that are different. So let me show you the first one and give you the logic behind it. And then you will have 7 and 8 to do yourself using number 6 as an example, only changing the numbers and thinking about this. So first of all, they ask us to record the increase in inventory on March 16th. Well, it doesn't tell you, but they charge these, okay? So they're on account. That accounts payable right here could very well be cash. Generally, it is an accounts payable, though. So we bought 20 at $70, which means I'm going to have to debit my inventory for $1,400, and I'm going to credit accounts payable for $1,400. And obviously, I'm going to give it a description on why I made that entry. Then, on the 31st, we sold 25 of them. So the first entry, that's very evident. You are going to increase your accounts receivable by $3,000, and your sales revenue is going to increase by $3,000. So you're debiting an asset and you're crediting a revenue account. Now, since we're using a perpetual system, we are going to record the cost of goods sold at the moment of sale. So that's where this right here becomes so important. We had numbers in here. I've since removed them. So whatever your cost of goods sold was, remember we took 10 times 60, because we had 10 on the first layer, and then we took 15 out of the second layer at 70. And if you multiply and add those together, you come up with a cost of goods sold of $1,650, and a decrease in inventory of $650. Now, if you do these out in a T account, you're going to see exactly the effect that cost of goods sold entry does on inventory. It's going to lower the inventory, and obviously it's going to increase the cost of goods sold or the operating expenses. So now this one was using FIFO. This one is going to be using LIFO. And this one is using weighted average. So you're going to do the very same thing that you've done here, only you're going to have different numbers here. So then you can look at and see the difference and how each affect the accounts. And then on number 9, I believe they're going to ask you some questions about the entire 3 through 8, which we've just done. They want to know which method of inventory produced the lowest cost of goods, which produced the highest, and then they're going to ask you, give you a scenario if prices were declining, which would be the best inventory to use. So I think you can figure that one out fairly well on yourself just by looking at your numbers. Take your numbers and look at them, and then think of the effects that this has on net income. So you're always looking at net income and the purpose or where they want net income to fall. That wraps up that series, and I think I will end this here, and then we'll move on to number 10.